Wall Street Week with Louis Rukeyser. Brought to you by public television stations. By Hanson Trust, a $10 billion transatlantic company with 23 consecutive years of growth in earnings and dividends by providing essential goods and services. By Prudential Bates Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. And by Primerica, the new name in financial services and specialty retailing, a company with the resources to fund growth for tomorrow. Primerica, a name to remember. Produced Friday, November 27. Our panelists are Frank Cappiello, Mary Farrell, and Louis Holland. Tonight's special guest is Merrill S. Rukeyser, financial journalist.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, folks, this was the week when I found out that this program is in violation of federal regulations. You see, the Federal Communications Commission ruled this week that radio and television stations could broadcast indecent programming from midnight till 6 a.m., but not before. Friends, we are clearly in serious trouble. Have those regulators not taken a look at the stock market lately? Have they ignored what's happening in the economy? Do they pay no attention to the ongoing farce in Congress? I mean, here it is still hours before midnight, and I've already been bordering on the outright obscene before I even get to the actual news. I couldn't think of anything more indecent if you kept me here till 3 a.m. Talk about indecent. This was the week when so-called financial experts, who for the previous month had been shocking us with talk about the possibility of a deflationary depression, tried on a different perversion by telling us the new bad game might in fact be inflation. As evidence, to the extent they ever bothered to stop to get any, they cited a notable bounce in commodity prices. The Commodity Research Bureau's futures index climbed to its highest level of the year, topping the previous peak reached in May. Gold and silver dutifully perked up, and those vehicles that are affected negatively by whiffs of inflation, such as bonds and the dollar, screeched into reverse. It may not be readily apparent how all this fits into last week's equally indecent scare scenario of prices and the economy falling into a pit. But whoever said you had to be logical to be an economic gloomster? For those folks, the third quarter economic data certainly would have to be rated X. Because, you see, just when the Great New Depression was supposed to have been looming, the performance actually turned out to be much stronger than expected. Real growth topping a husky 4% rate. Exports and business investment perking up, unmistakably. And corporate profits recording their biggest jump in a year. Quick, Lulu, put on a G-string before somebody out there notices. The question remains, of course, whether all that dirty talk about a stock market crash will ring down an early curtain on consumer spending, which turned flat last month, and whether anything at all mentionable in polite company will ever emerge from Washington. I don't see any way out of it. Either the FCC is going to have to change its rules, or you're just going to have to start putting the kids to bed earlier on Friday nights before I begin reporting the indecent news about the economy. Meanwhile, since plainly the only way for me to do my duty to you and still stay out of jail will be if we keep this all in the family, it seems appropriate that my guest tonight is a man who first appeared 3 years ago as my father, but who since then, on his own merits, has become the single most popular guest we've ever put on, and who I am sure will, as always, do a more than decent job. But first, let's really get pornographic and see what happened this past week in Wall Street. The Dow Jones Industrial Average did try there for a while, but when it couldn't go up either the day before or the day after Thanksgiving, days when the market usually does have a bit of a celebration, skeptics concluded that the next move was likely to be down and chewed up all the week's winnings, leaving the Dow with a 3-point loss at 1910.48 on the slowest trading of the year. The New York and S&P composite indexes followed the Dow, but the long-battered secondary stocks had a better holiday week, with the Amex and over-the-counter markets both posting gains. Our elves, meanwhile, remain adamant that better times lie ahead. Though their technical market index slipped one notch, it still managed to give its 6th straight weekly buy signal, thereby doubling the previous longest stretch of bullish forecasts. I hope it's just a coincidence that this was the week of the turkey. And in view of the seniority of my guest tonight, let me hasten to report on the results this week of the first national study of the 2.2 million Americans aged 85 or older. It found that only 30% of them were men, but those lucky fellows had more money and better health than women the same age. Not to mention a much wider choice of dates for Saturday night. Frank Cappiello, is this stock market worth flirting with?
I think it is, Lou. It's very heartening for us when we reach 80. You know,
Are you reached it, Frank? Happy birthday. That's
Thank
marvelous. Don't look a day over 75. I think that's terrific.
I think you know, my head is bloody but unbowed. I think we've probably seen the worst, but this market is still chewing through a lot of fear, Lou. There's a lot of tax loss selling going on. There's fear that the Federal Reserve is now draining liquidity out of the system. The money supply has been falling, and people are worried about that. And then there's fear of the dollar, so there's still a lot of fear out there.
Well, it sounds like you're not quite as confident that we've seen the lows as you were last time I spoke with you.
I think we might go down to test the lows. I don't think we're going to penetrate the lows, the 16 to 1700 area. I don't think all the stocks are going to go down at the same time.
Would you buy anything here?
I think I would. One of the things I think I would begin to buy, again, you know, the utilities is still a safe out. I think some of the other stocks would be interest-sensitive stocks that I think will do well next year in a slowdown in the economy, which we all expect. No recession, but a slowdown. Stocks like Fannie Mae, for example, would be, I think, an appropriate buy.
Mary Farrell, Frank says slow down. He doesn't seem to be worried about inflation. How about you?
I'd agree. I think we're going to see certainly some slowdown in the fourth quarter, and that could lead to a modest growth recession in the first quarter. But I think the market is really discounting a far worse economic outlook than we've seen. And on the inflation front, I'd note that even though you can see some evidence of inflationary pressures, we're really not at all in a situation like the 70s where we faced a worldwide inflation problem. And there's ample capacity, ample unemployment, and I think that argues against a problematic inflation.
When's the market going to be as cheerful as you are?
Well, I think, unfortunately, there's still a fairly heavy component of emotionalism in the market here. I think the value risk is out of the market, but with that emotional trading, I think, as Frank says, you could see some testing of lows, but certainly only a modest upward bias over the next few months.
Keep your powder dry for a while, you think?
I would say so.
Lou Holland, what do you make of what's been going on?
Well, I'm slightly more positive. I think that I think one can make commitments 50 to 100 points either side of where we are. I think sometime by the first quarter of next year, I think you're going to see stocks in the 2100 to 2300 range. I am troubled, though, on a short-term basis because the bond market has not been doing particularly well. Much of our work still is troubled with regard to what's happening with bonds. Even though we have had a big rally, I suspect that will stall here over the next month or so, which it's already stalled. As Frank said, the Fed has taken some liquidity out of the system, so it's possible that we could retrace some, but certainly I would be a buyer on any retracement.
Would you rather be in stocks than bonds right now?
I think so.
All righty, this now is the point in the program when we usually pause for a round of viewer questions. That time this week goes to your local public television station so that it can ask you for some much-needed financial Thanksgiving the minute we go off the air. But we'll soon be back to leading our usual fundraising pilgrimage for you. So keep those money questions coming to us here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. And now let's go over and meet the fellow for whom I'm very thankful, tonight's special guest, Merrill Stanley Rukeyser. Hello there. Stay where you are. Welcome. If his last name had been anything but Rukeyser, we would not have waited until 1984 when this program had already been on the air for 14 years, to extend our first invitation to Merrill Rukeyser, who was financial editor of the New York Tribune when he was 23. That was 1920. Who wrote a nationally syndicated newspaper column for more than 30 years, and who is known by me to be a very good guy to boot. Once he appeared, though, the only question on viewers' lips seemed to be, when will he be back? And so tonight, 5 weeks before his 91st birthday, he is making the third of what we hope will be at least 30 appearances. Let's start at the top of the news. You were a leading financial commentator during the crash of '29. To what extent are we seeing a repeat of that in 1987?
There you go again. I'm quoting, not plagiarizing. The things were different in 1929. I was saying a little while ago that I was at a dinner party 2 days after the big break in Wall Street in 1929, and a very gracious lady guest said, "Mr. Rukeyser, were you caught in the panic?" And I said, "No, I was out of town." It's very easy to make comparisons if you are a Monday morning quarterback, and I'm sick and tired of all these gurus who tell us about the support points, which I didn't find on that fatal Monday. The only thing that's constant in comparison this year with 1929 is human nature and human psychology. And we still are subject to the madness of crowds.
Did the crash cause the Depression?
Absolutely not. The business remained reasonably good until the following June, after October. As a matter of fact, those speculators who were on the wrong side of the market in October 1929 jumped out of the window prematurely. They didn't wait for the technical rally.
You were quoted earlier this year in one magazine with something that still sounds pretty good to me. You talk about constants. You said, "There's no sure investment, no chance of being right every time. All you have to work with is careful selection, persistent supervision, and diversification to cushion your mistakes. Successful investors know themselves and do their own thinking. They don't react to each market fluctuation. They find a good investment and let it pay off." Would you want to amend that at all now?
No, that was pretty clever of me. I didn't remember saying that.
Are you still a holder of common stocks?
I am, but I, with the advice and consent of my heirs and assigns, I took advantage of my age and bought a non-refund annuity so I could afford to hold common stocks that only paid a small rate on the purchase, the market value.
But when you were investing for your own account, you still believed in the future of the stock market?
Yes, and I believed that I was assuming certain risks. I didn't think I was making a riskless adventure.
You're obviously not a newsletter writer because they don't have any risk. They just tell us they know the answer.
Well, if you subscribe for about $60 to $80 a year, you can have this riskless adventure. The only thing is they run out of town after a big break.
Your life covers a whole cycle in American life in terms of our international position. We were a debtor nation, we became a creditor nation, now we're a debtor nation again. How can we become more competitive in America?
By a return to excellence. When I was writing a daily column, I'd comment on the crusade against excellence. The labor unions, for example, were telling people not to work too hard, not to produce too much. All kinds of negative things were going on. People who, through seniority, became chief executives were taking the perks and not producing.
Why were we able to get away with that for so long?
Because we had a uniquely productive technology. And after the end of World War II, we were in the hands of good doers good in the White House and elsewhere. The Marshall Plan was all right. Point 4 was all right, but they shouldn't have been all-time gifts. They should have been help to weakened nations which had been shattered by war. Maybe we should have given them an interest-free loan for 5 years and then picked up the back interest later and amortized the loan. And even today, when we've had amateurs, little men in big jobs, calling the shots in the Treasury and in the White House, it's high time that we told Great Britain, France, Italy, and some of the others, don't point the finger of shame at us. We haven't been able to collect $1 yet on the intergovernmental loans of World War I from Great Britain and France, and of all the ones that we lent money to, only little Finland returned the loan.
Are these politicians brighter or dumber than they used to be economically?
I don't know. We fluctuate, and I don't know whether one should be a Democrat or Republican because they changed policies since I was a boy. When I was a boy, the Democrats stood for tariffs for revenue only. Republicans stood for protective tariffs, and you could go all through the policies. And in the days of the height of the New Deal, and I was a great friend of Franklin Roosevelt, of course, I want to make clear I only voted for him once as president. I voted for him twice as governor. But in those days, it was very popular to do deficit financing, and it was a new invention. And if you didn't go for it, you weren't a liberal. And the late Orlando Weber used to say a liberal is a fellow who's liberal with the truth and liberal with other people's money. And if you didn't think that deficit financing was good as a permanent policy, you were considered a reactionary. And a reactionary was a fellow who could add.
Apparently neither party listened to you in those days. That's a shame. Well, let me these three young fellows in on this, too, starting with Frank Cappiello, who is just 80.
Thank you, Merrill. One of the problems ascribed to looking ahead with the stock market today is the political situation. And they're relating the problems of '88, the change of administration, to possibly what happened in 29, 30, and 32. How do you view this in '88?
Well, I've tried to be nonpartisan all my life. I've never registered in either party. But I say to the American public, if you want to return the United States to excellence and to world leadership, don't vote for anyone of either party or any party who hates business, who thinks that finance is wicked, and who wants the United States to have costs that are different and higher than those of competing nations. The reason we were able to do it before, I was going to say when I was interrupted, was that we had an exclusive use of technology, of high technology, and we were able to overcome high money wages with technology. But in connection with the post-war aid, we not only gave them the money, but we gave them the technology. We built them new plants, and we tried to compete with obsolete plants and obsolete tools. And then a new group of management came in, sort of intellectual hippies, and they were catering to analysts who were only looking at 3 months' earnings. And they didn't have the great days of General Motors when Sloan was there for 40 years and was trying to look down the road.
Merrill, I went back and read your 1924 book, The Common Sense of Money and Investments. And the amazing thing was that common sense still stands today. It was an excellent book, even for these times. But I'd like to ask you to answer a question that you posed and answered in the book in 1924, which has the day of opportunities gone. Economists of the day were worried with the end of free land that there wouldn't be any more opportunity. You responded the agricultural revolution, the industrial revolution would provide more than ample opportunity in the future, and even cited the machinery of money-making of Wall Street, for example, would make it all possible. You were right. Can you put your crystal ball in front of you and tell us, is there still opportunity here?
To answer briefly, yes, better than ever.
Good.
Back in the 20s, or back in the actually 1930, we had a tax increase, we had the Smoot-Hawley tariff bill, and it seems to me we're going down the same path again, meaning that we have proposed tax bills coming up, and we also have a trade bill on the table. What do you think about all of this?
Well, I think that anyone who can't see any other road but the one we followed in the Depression of the 30s is very stupid. and I think we should avoid those things. And I'm against suckers in finance, but I'm equally against suckers at the ballot box.
You're going to be 91 January 3rd. What do you think of the idea of mandatory retirement at 65 when an adolescent is just beginning to learn something?
I think it's terrible. My late colleague Arthur Brisbane used to say as soon as a fellow gets the hang of the job, they retire him.
Corporations argue that if they didn't move them out, that younger executives would be restless. How do you respond to that?
Well, if they're restless, let them move on.
You think the job of the corporation is not to please younger executives?
That's right. They're supposed to work for stockholders, and I'm greatly against this present tendency of management to try to buy out the stockholders. They're supposed to work for them, not to trade against them.
We only have about a minute left. You were in at the start of Social Security. We're told we can't discuss Social Security. It's off the table. How do you respond to that?
It's ridiculous. Nothing should be off the table. If you do that, it's the road to bankruptcy.
What suggestions would you make at this point?
Well, I was dragged into Social Security willy-nilly. I could have planned my own retirement, and I could have done better. This way, they created, with the Medicare especially, skyrocketed medical costs, so I'm worse off than if I were paying my own bills at the older rates, plus inflation.
Now they're talking about taxing you more heavily on your Social Security benefits and raising your Medicare payments. How do you feel about that?
Well, when I first appeared on your program, I did what I could to shut up Senator from Florida, who's always on the side of the aged. I'm on the side of any group.
You told us that you objected to the notion that Claude Pepper was senile. You said he was equally fallacious 45 years ago.
That's right. He's, if anything, become more sensible.
We heard from some of Mr. Pepper's friends then. I'm sure we will again. Thanks very much, Merrill Rukeyser, for being with us, and we look forward with joy to the next time. Thanks to panelists. Hope you will be back with us again next week. Then my guest will be one of Wall Street's top observers of our toughest overseas competitor, Japan. He's Paul Aaron. We'll ask him both what lies ahead in the two nations' embattled trade and where an American investor might look now for values in the land of the rising transistor. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been brought to you by public television stations, by Hanson Trust, a $10 billion transatlantic company with 23 consecutive years of growth in earnings and dividends,